1. We're going to start by looking at financial maths, specifically the unit called earning and managing money. Okay, so earning and managing money. We're going to start by going through a couple of different definitions that give you a bit of an overview of what these terms that you'll see mean. The first thing is gross pay. So gross pay is the total income that a person earns. So it's their salary, interest from savings, rent from investment properties. It's all of the money that enters their bank account, right? So you will, obviously, we'll talk about deductions later, but you might earn money from babysitting, money from a savings account, money from your tax return, or you don't get tax from that, but money from work, money from netball training, right? This is your gross pay. This is everything that goes into your account. We then have allowable tax deductions. These are expenses that can be deducted from your gross pay. So when you go and lodge your tax, once you're an adult and you earn enough money to pay tax, things like a charity donation or buying your uniform for work or a work car if you're so lucky, or a work trip. These are all things that you can deduct from your tax, right? So the ATO says, look, we're not going to make you pay tax on the uniform that you bought to wear to work or the laptop that you do your work from. We then have tax payable. So this is the amount that you actually need to pay to the government. So if you're not familiar with what tax is or why we pay it, in Australia, there are a lot of things that we essentially get for free. So Medicare is fairly free. You get, your bins are, provided to you from the government. The roads are built. We have hospitals. We have free public schools. We have healthcare. We have events and entertainment and so many things that we can access for free that we pay tax so the government can do that, right? So the tax payable is the amount that you need to pay to the government, and it's calculated based on how much money you earn, which is your taxable income. So it's your gross pay minus all of those deductions, and that is the taxable income that we use to calculate how much tax you owe the government. That is Luna running around barking. Okay, net pay is the amount of income a person owns after tax and deductions. So you can kind of think of it like this. We start with our gross pay. This is everything. We then minus our deductions. We then pay our tax, which is calculated based on this and this. And then once that's gone, we're down to our net pay. So this is the amount of income that's actually going to go into your bank account. Okay, there it is. Taxable income equals gross pay minus allowable tax deductions. Okay, so the Medicare levy, this is kind of what I just referenced. This is an additional tax that we pay so we get free or subsidized public health care. So when you go to the doctor and you go in and you might get, just a little ear exam because your ear hurts, you hopefully might not have to pay anything. Or if you're my age, you pay like a gap. So you pay like $12 or something because the rest of it's covered by Medicare. So it's currently 2% of a person's taxable income. So if my taxable income is $100,000, my Medicare levy is going to be $2,000. Now that might seem like a lot, but if you've ever seen someone like go to the hospital in the US, it costs like $6,000 to get the ambulance there, right? So people don't even call the ambulance. This is why we have Medicare, so that you're paying this amount, but then everything else is virtually free. Okay, so pay as you go, or PAYG. If you already are working, you might see this on your payslip. It's on my payslip. It says PAYG tax, and it will tell me how much tax my employers have deducted from those pay slips. So this is a system where you pay tax throughout the year based on what the ATO or what your employer thinks you're expected to pay, right? So this is like if you earn, let's say $1,000 a week, the government, right, and you do that for a couple of weeks, the government reasonably expects that you're going to earn $52,000 in a year. Now, this might not be true. You might lose your job. You might move jobs. You might get a pay rise. You might get a decrease in pay. But they suspect that you're going to pay this much. You're going to earn this much money that year. So they deduct an amount that they suspect you would be paying at the end, but they deduct it each week so that it just kind of adds up over time. Now, this means at the end of the year, you're either going to receive a tax refund where you get money back, 3 years running. I've got those, luckily. Or you have to pay more. So this is where they actually underestimated how much tax you would be earning or paying, sorry. And so you actually have to go and give them more money. So this is what you want. This, no fun. But do pay it. Otherwise you'll be guilty of like tax fraud or something. So the way that this works in maths questions is they're going to ask you a question about some hypothetical tax. And then they're going to say, does this person get a tax refund or do they have to pay a tax bill or a tax payment? All right, so we calculate our tax payable using what we call a tax table. So you'll see that we have our taxable income and then we have tax on this income. If you earn less than $18,200 a year, you do not pay tax. This is why I suspect most of you will be unfamiliar with paying tax, because if you're earning $18,200 a year as a year 11 student, well done, you're killing it. Most of you aren't. Once you earn enough, you'll move into one of these 4 brackets. Now, don't worry if this table looks old. It changes most years. The questions will use different ones. You don't need to know this table. You don't need to know anything about it, right? You just need to remember how to use it. The first thing is to find out which of these 4, unless it's under 18,000 brackets, your taxable income falls in. So you'll get an amount of money, you probably have to do some deductions, and then you figure out which one of these it falls in, and then you follow the instructions. So for somebody who earns between $37,001 and $90,000, or rather has that taxable income, their tax is $3,572 plus 32.5 cents for every dollar that they earn over 37,000. So if they earn, let's say 38,000, you would be doing 1,000, because that's the difference between 37,000 and 38,000, times 32.5 cents, and it would be something like $325 added to 3,572. Okay, so it makes a little bit of sense, hopefully in theory, but let's look at it in practice. Let's actually do an example. So this table shows the tax payable for different taxable incomes. It's the same one that I just showed you. Leslie has a gross annual salary of $92,000 and tax deductions of $1,200 for work-related travel and $350 for stationery. The Medicare levy to be paid is 2% of the taxable income. Leslie has already paid $22,400 in tax. Will Leslie receive a tax refund? Justify your answer with calculations. So this question is touching on all the things we've just talked about. We have our gross pay, our deductions, our taxable income, our tax payable, and our refund or payment. That's all of the things we just talked about. So what we need to work out is our taxable income, which is this gross pay minus our allowable deductions, which we underlined. So 92,000 minus 1,200 minus 350 gives us a taxable income of $90,450. So we then need to work out the Medicare levy. So we know that we have a taxable income of $90,450. The Medicare levy is 2% of that, which is $1,809. And so now we know our taxable income is $90,450. Our tax payable is going to fall into this bracket because it's between $87,001 and $180,000. So we follow the instructions. $19,822 plus 37 cents for every dollar over $87,000. So we have to find every dollar over 87,000 by doing 90,450 minus 87,000, and we times that by 37 cents. So we can see this is like $1.37. If you just timed it by 37, you would be getting your answer in cents, not dollars. And that gives us a number of $21,098.50. So let's go back through our question. The tax payable we've just worked out is $21,098.50. we've got a Medicare levy of $1,809, and we know Leslie has paid $22,400. So we know that she's paid $22,400. She actually owed $21,098.50 and $1,809. So if we subtract both of these from what she's already paid, we actually end up with negative $507.50. Now, yes, this number is smaller than this number, but because of our Medicare levy, we actually owe a further $507.50 in tax. So this question, you would not receive a refund, you would receive a tax bill, and you want to answer it something like this. You would want to write like $507.50 payment, and then you can even indicate like right under that, will not receive a refund. You don't want to leave any ambiguity for them to go, oh, did they really understand the question? Did they really answer it correctly? You want to be as specific as possible. So you want to indicate they owe a certain amount of money, they will not receive a refund. Okay, so we're going to go through these questions together, but kind of in real time of me working them out so that you can see, okay, this is how I would work it out. You can kind of do it with me. This is from the 2016 HSC General 2 exam. Theo is completing his tax return. He has a gross salary of $82,521 and income from a rental property totaling $10,920. He is claiming $13,420 in allowable deductions. So the first thing we need to do is determine Theo's taxable income. So we have $82,521. He has income from a rental property totaling $10,920. So we have to add that because that's income, not a deduction. And he's claiming $13,420 in allowable deductions. So we're doing his gross income from his job plus the income from the rental property minus his allowable deductions. So 82521 plus 10,920 minus 13420. And that gives me $80,021. So if we know he earns $80,021, he's going to be in this tax bracket, which means it's going to be $17,547 plus 37 cents for every dollar over 80,000. So $80,021 minus 80,000 is going to leave us with, so we do 17547 plus 0.37, and then we do in brackets, give me 2 seconds. Brackets, we go 80021 minus 80,000. And that should leave us with 17,554.77. Okay, so we've got 17,500. Oh, hang on. Actually, no, that was wrong. Let me check my answer. 17,568. Oh no, 17,500 and 54. Sorry, no, that's the correct answer. 77, and you'll see here we've got them worked out. Again, these are our correct answers: $80,021, $17,554.77. And again, it was $21 that we had over the threshold, which if we do times 37 cents, 37 cents gives us $7.77, which is added on to 17,547. Okay, here's another one of our questions. Last year, Luke's taxable income was $87,000 and the tax payable on this income was $19,822. This year, Luke's taxable income has increased by $16,800. Use the table to calculate the tax payable by Luke this year. Okay, so his taxable income was $87,000 and the tax payable on this income was $19,822. His taxable income has increased by $16,800. So we need to do 87,000 plus his new increase, which is 16,800. 87,000 plus 16,800 gives us $103,800. That places him in this bracket, which means we need to do 19,822 plus 37 cents for every dollar over 87,000. So it's 103,800 minus 87,000. And that should leave us with $26,038, I believe. 26,38. And then how much extra money will he have this year after paying tax as a result of the increase? Ignore the Medicare levy. It's just a minus problem. So last year he paid 19,822. So we go 19,822 was last year, and we want to subtract that from 26,038. 26,038 minus 19,822 gives us a difference of $6,216. So if we go paying tax as a result of the increase in his taxable income, so we want to add that to his new income, so 103,880. So you'll see here that once we've added that to we've subtracted our payable tax, then we've added that back on. So if we do, our payable tax was 103,800. So 103,800, we minus the tax we're actually paying, 26,038. That gives us $77,762. And we actually have an extra, what was the amount that we just worked out? Like 6,000 and something. And we add that to that. We compare that to the 87,000 minus 19,822 from last year. We end up with a difference of 10,584. So that's how you'd work the second part out. Okay, let's jump into one of our last questions here. Simon invests $4,000 for 3 years at 6% per annum simple interest. Monica also invests $4,000 for 3 years, but her interest rate is 5.6% with interest compounded quarterly. Calculate the total amount Simon earns after 3 years. Okay, so this is kind of giving you an insight into those interest questions. So interest is the amount of that you can earn on a payment that you give a bank, or it's an amount of money that you can owe. When we're investing, we earn money. So Simon invests $4,000. So simple interest, which hopefully you've covered in year 9 or year 10, is I equals PRN. So the principal is $4,000 times the rate, which is 6% per annum, so 0.06 times 3 years. So 4,000 times 0.06 times 3 years, he earns 720. Now, compound interest is our future value. This is kind of like, you won't usually use this formula, but I'm just going to show you for the sake of it, is present value 1 plus the rate to the power of n. So our future value, we want to work out for Monica. She invests $4,000 as her principal. Her rate is 5.6, but it's compounded quarterly. So 5.6 divided by the 4 quarters in a year is 1.4%. So 0.014 as a decimal. And she does that quarterly for 3 years. So that's 12 times. So 4,000 times, and then we do our brackets, 1 plus 0.014, close brackets, to the power of 12, which is very hard to do on a phone. That is how you get your answer, is via this. Now, whose investment is worth more? Without even doing it, I can almost tell you it's usually going to be the person who uses compound interest. I don't know if I have my calculator sitting here with me. It does kind of move around a lot based on... Oh, I think I've got it onto here. There we go. It's always missing after tutoring sessions, but I can confirm. Hold on. 4,001 plus 0.014 to the power of 12 is, 4,726. And Simon's is worth 400 plus 720, so 4,720. So Monica's is worth more. Fun fact, I've had this calculator since my first day of year 7, which was in 2015. So it is, I guess this is its 9th or 10th year, and you'll see it doesn't have any numbers anymore. They are completely rubbed off, but muscle memory, I know where they are. Okay. We're also just going to do this question as our very last. Find the rate of simple interest paid per year if an amount of $14,000 earned $5,880 in interest over 6 years. So this is where we're actually turning it around. So we know that it was simple interest and it earned $5,888. We know that our principal was $14,000. Scrap that. Hold on. Did that the wrong way around. Okay, so our formula, where's my pen gone? For simple interest is I equals PRN. Our interest was 5,880. Our principal was 14,000. Our rate is what we're looking for, and we know it was over 6 years. So what we can do is 14,000 times 6, which is 84,000. We subtract that from 5,880. So 5,880 minus 84,000 gives us a very large negative number. And then we want to divide that. We'll do this the other way. Instead of that, we'll divide 5,880 by 6. So we'll go divide this by 6, divide both sides by 6. And this becomes 980 equals 14,000 times the rate. And then we can divide 980 by 14,000. And that gives us 0.07, which is also equal to 7%. Isaac invests $45,000 at 9.2% per annum for 5 years with interest compounded 6 monthly. Future value of the investment. So we're looking for our future value. We've got 45,000 invested at 9.2% per annum, but it's compounded 6 monthly. So that's twice a year. So the actual rate is going to be 4.6%, so 0.046. And then we're going to pop, it's twice a year for 5 years, so it's 10 time periods. So 45,000, 1 plus 0.046, close brackets to the power of 10. This investment is going to be worth $70,555.25. Okay, that is earning and managing money and how to ace our tax and interest questions all wrapped up. So let's have a look at my kind of 3 top tips. First of all, read the question very carefully to make sure that you're using the correct amount for your calculations. If you use the wrong part of the tax table or the wrong interest formula, your whole question is stuffed. Next, to make sure to answer the question, if it asks does the person receive a tax refund, yes or no answer. Show every calculation, so sometimes you can get those error carried forward or correct from previous working answers, even if you use the wrong part of the tax table, but you knew how to use the tax table.